Hey everyone, this is Purti and this video is a follow-up on the previous video of the GME short squeeze, and in case you missed it, watch it on the link in the description below. One thing I forgot to mention in the previous video is that margin is utilized for the short positions the hedge funds hold, and with every passing day they need to pay interest on those. So if they suffer losses, their total loss will be the losses on their short positions plus the interest, and it ain't cheap, I can tell you that. So let's play out some possible scenarios of how all this will end. Case 1. GME stock continues to rise. This is an optimistic case for the retail investors and the worst case scenario for the hedge funds in their short positions. These hedge funds have a small percentage of their portfolio in cash. Rest are invested in trades, that is, some positions are long and some positions are short. If a margin call occurs, the hedge funds need to liquidate their short GME as well as their long positions to compensate for the loss. Of course, this would be the worst case scenario, as it has not only suffered losses on the short GME but also lost capital for long-term assets. Maybe this is what happened over the last few days in the market, where Nasdaq, S&P 500 and Dow Jones Industrial Average sold violently, stating volatility in the market. I wonder. Case 2. The retailers call it quits. In this case, the retailers become weak. Instead of holding on to the stocks they purchase, they start cashing in their profits, that is, start selling the stocks. In this case, all hedge funds need to do is wait out till the stock falls below their short price levels and they could close out their positions for a small profit. In this case, retailers lose the short squeeze, and usually the retailers who buy the stock near the highest values are left holding the stock. And guess what? For short squeezes, the fall is violent and swift and people don't even have time to react. The good thing though is that as long as people keep buying the stock, it's more painful for the hedge funds. Of course, if you're a hedge fund manager, you would hate me for talking about this. Case 3. The SEC steps in. In this case, SEC says that there is something fishy going on inside and halts trading of GME for the foreseeable future. This is done to investigate any malpractice or misdemeanor on behalf of all the parties that violates free market trading clauses in the SEC guidelines. This would mark the end of the short squeeze. The respective accounts that hold the positions in the stock will be frozen, and after long waiting periods, funds would be released. I've heard it may take up to 6 months, but don't quote me on that. At the end of the day, whatever gains or losses at the time of the freeze would be collected from respective parties and life moves on. Whatever scenario plays out there, I think all of us are going to be losers, because to be more precise, if the hedge funds lose, then all the positions which are usually good, that is all the long positions, get liquidated to raise capital. What that does to your pension funds, which holds a lot of these good stocks, they could go down in value. Think of your 401k, for example. If the market still has the buy the dip mentality, we could recover. On the contrary, this sell-off could push buttons on long positions and the big institutions would unwind their securities and move to cash. If the retail investors lose, then the market is going to lose new money or young money joining the market. Less participation in the market leads to lower wealth, which in turn leads to lower growth and financial disparity among the people. All that extra money people make no longer goes into the market but for buying stuff, which could lead to inflation. Amongst other scenarios, the SEC might introduce new laws that regulate markets, and we all know what happens when the government interferes. Markets don't reach their full potential. There are talks of banning short selling, which in my mind is a catastrophic mistake, and it removes movement in the markets. Short sellers are essential to the markets, no doubt on that, as they provide liquidity of the stocks to the markets. Regulations curbing short selling would shock the markets, from which I doubt the market will ever recover. Keep in mind the root cause for all what's happening is the Fed monetary and fiscal policy. Money is so cheap that the hedge funds borrowed a lot to short the stock. The fiscal policy people put in money in the people's hand and they thought it was a great idea to invest in the market. All in all, it's a wait and see how all of this evolves. One thing is for sure that we are in turbulent waters and living in very interesting times. I'll do my very best to bring you important events as they progress, but please let me know in the comment sections below if there is something you think I missed or you want me to cover. I'll be happy to provide that information in my upcoming videos. Let me know what you think of this video and post your questions in the comments below. If you like this video, don't forget to like, share and subscribe and hit that bell icon for more videos on financial literacy. Thanks for joining me today and I'll see you all in my next video. Bye-bye.